What is going on, guys? Nick here, back with another video. Today we're going to take a look at one of Warren Buffett's favorite companies, Coca-Cola. So Coke reported earnings on February 10th and the headlines look pretty good. Coke said earnings beat estimates as demand for drinks away from home topped pre-pandemic levels. But Coke also warned investors that it expects 2022 to come a little short of expectations with lower than expected guidance reported. They expect rising costs for packaging and transportation to increase over the next year, eating into some of their profits. Coke reported that their sales increased by 10% compared with the same quarter last year, and that even when you take out its acquisitions and just look at its organic revenue growth, they still jumped by 9%. Now, Coke, of course, is much more than the red can cola drink that you think of. Coke actually has a massive catalog of drinks that you may not even realize are Coke because they don't really advertise with Coke branding. Here's a list of some of the companies. You're welcome to pause and read through if you're interested in reading, but I think what should stand out is the wide range of drinks they cover, from Innocent, which is definitely one of the trendier health drinks, all the way to root beer and sweet tea. So Coke's earnings came in at 45 cents per share versus 41 cents expected, and revenue came in at 9.46 billion versus 8.96 billion expected. When we look at the trailing 12 months of earnings for each reported quarter, the most recent report is in red on this chart. We can see that while it was a little smaller of a quarter than we've seen in the past, it still looks like Coke's earnings are headed in the right direction. Now, zooming out a little and looking at the past 10 years of earnings and profits for the company, we can see that Coke has actually gotten more efficient over the past 10 years, with revenue actually dropping quite a bit, but profits have remained steady. However, over the past 10 years, they basically had no change in their profits. In 2012, they earned 8.5 billion, and over the last year, they earned 8.1 billion in profit. When we look at revenue versus expenses, what's pretty surprising to me is how low their cost of revenue is. I expected this to come in much higher because food and drinks are a very competitive industry, so it's surprising they can charge enough to give them this much profit margin. Okay, when we look at Coke's segments, we can see that clearly North America is the largest producer of revenue. Still surprisingly, both Europe and Latin America produced more profits. Coke also has a decent amount of revenue they earn from just their bottling segments. However, while this does produce a lot of revenue, it generates almost no profit. When we look at the current forecast for Coke, we can see that revenue growth is projected to continue along with modest profit gains. The current projection is to see Coke go from 38 billion in revenue and 9 billion in profits to 46 billion in revenue and 12 billion in profits by 2024. Now, normally I use a PE ratio correlated with a growth rate to value stocks. However, I don't really think that that's the best way to do it for Coke since they're not really a growth stock, they're more of a dividend stock. So to show you guys what I mean, let's value them with 0 to 4% growth, which gives us a fair PE value between 8 and 13. So if we were to value them based on earnings alone, that puts Coke's value around $20 to $30 per share, which is insanely expensive compared with today's price of $63 per share. But Coke is priced so much higher because of their dividend. Right now, Coke is paying about $1.76 per share in dividends, so if it were to trade at about the middle of its earnings fair value, that would be almost a 7% dividend yield, which would be awesome, but this is way too high quality of a company to ever happen. We need to consider when looking at dividend companies is how their dividend payout compares with their earnings. So when we look at Coke's dividend payout compared to its earnings, we can see that this is actually a fairly tight payment. Nearly all of Coke's profits are being divested. This can be a concern if there is any downturn for the company. However, when we look at their current forecasted earnings per share over the next few years, it seems like their earnings per share should go up enough that it doesn't seem like this will actually be a big problem. I think Coke's dividend is pretty safe as long as this happens. So Coke's value is really built on that dividend payment. It yields about 2.81% per share, which is pretty good considering treasury bonds currently pay out a little bit less, a little under 2%. However, the amount Coke will have to pay out over the next few years probably will go up faster than treasury bonds. The issue is, as interest rates rise, dividend yields will probably increase. And that sounds good on the surface, but not necessarily if you own the stock. The issue is, for earnings yields to increase, the dividend either has to increase really fast or the share price has to drop. Now, it's hard to say exactly how much Coke will increase its dividend payments, but it's going to have to go up enough to offset some of the drop in demand for stocks that have basically behaved like bonds over the past couple of years. Now, before you go, I recommend checking out this other dividend king, Microsoft. It may not pay as good of a yield as Coke, but their dividend payments have actually doubled over the past 5 years. And as always, thanks for watching.